Something feels different about 2026. As we head into 2026, the market is in an unusual position. It is not clearly overheated, and it is not clearly fragile. It sits somewhere in between, in a space that rewards careful thinking more than bold predictions. The S&P 500 closed out 2025 at valuation levels well above its historical average. The index multiple is roughly double its long-run norm. That alone does not mean a decline is coming. Valuations can stay elevated for a long time when earnings growth and liquidity support them. But when prices are high, expectations are high too. Companies need to keep delivering strong results to justify where things stand. Market leadership has also narrowed considerably. A small group of very large tech companies now drives a significant share of total index performance. When investors buy broad index funds, capital flows automatically toward the biggest names, because that is how market cap weighting works. The larger a company gets, the bigger its share of the index, and the more money it attracts from passive flows. That structure is not unstable on its own. It has worked well when those leading companies keep growing. The risk shows up if earnings momentum slows or sentiment shifts. In that case, the concentration makes the adjustment sharper. Meanwhile, the interest rate picture has changed. Central banks that spent years tightening in response to inflation have started easing. Even gradual rate cuts change how future cash flows are valued. Lower rates support higher equity prices because they make future earnings worth more in today's terms. Fiscal policy is still running hot as well. Government spending continues at elevated levels. Deficits push liquidity into the economy and support demand. Unlike monetary policy, fiscal spending does not reverse quickly. Budget programs tend to persist. So entering 2026, we have elevated valuations, concentrated leadership, easing monetary policy, and ongoing fiscal support. That combination can keep asset prices moving higher. But it also means markets are more sensitive to any change in expectations. The feeling that 2026 may be different does not come from valuations alone. It comes from several structural forces stacking up at the same time. Between 2024 and 2026, a large share of the global population has moved through election cycles. Major economies, emerging markets, and strategically important regions have all experienced political transitions within a compressed window. Elections are normal. Markets have dealt with them for decades. What makes this stretch different is the density of transitions happening so close together. When multiple large economies reassess leadership and policy direction at once, uncertainty increases. Trade relationships can shift, regulatory priorities can change, fiscal strategies may be reworked. Investors have to evaluate more variables at the same time. Debt levels add another layer. Public borrowing expanded significantly during the pandemic. Corporations refinanced aggressively when rates were low. Households took advantage of cheap credit. Now, as those obligations come due, refinancing is happening in a higher rate environment. That does not automatically create distress, but it does mean the overall system is more sensitive to where rates sit than it was 10 years ago. Technology is another force in the mix. Artificial intelligence is no longer experimental. It is embedded in how companies operate, from customer service to software development to data analysis. These tools improve productivity. Companies can do more with fewer manual inputs, but labor structures are adjusting too. Some roles are expanding while others are contracting, and that creates transitional friction as the economy reallocates talent. Information moves faster as well. Automated trading systems and algorithmic models react to headlines within seconds. As synthetic media improves, separating verified information from noise may take more discipline. Even brief confusion can create short-term volatility. Climate variability also adds pressure at the margins. Weather disruptions affect crop yields, insurance pricing, infrastructure costs, and energy demand. These are not dramatic one-off events. They are recurring adjustments that show up in margins and pricing across sectors. No single one of these forces determines where markets go in 26. The significance is that they are all happening at once. Political transitions, debt sensitivity, technology adoption, faster information flow, and climate-related costs are all overlapping. That overlap widens the range of outcomes we should be prepared for. To understand how these forces translate into market behavior, it helps to look more closely at liquidity and how valuations actually work. Valuations reflect two things: expectations about future earnings and the rate used to discount those earnings back to today. When interest rates fall, the discount rate drops. That makes projected cash flows worth more in present terms. Even if earnings estimates stay the same, lower rates can support higher stock prices. But rates are only part of the equation. Over time, earnings growth has to support where prices are. If valuations keep expanding without real improvement in profitability, the market becomes more dependent on continued liquidity to hold things together. Passive investment flows have changed the mechanics. Retirement contributions, institutional allocations, and ETF inflows mostly move through market cap-weighted vehicles. Capital gets allocated based on company size. Larger companies receive a larger share of new money automatically. That amplifies trends in both directions. When big names do well, their index weight grows, and even more capital flows in. During pullbacks, the same dynamic works in reverse. The combination of concentrated leadership and passive amplification means markets can move faster in both directions. That does not guarantee instability. It means sensitivity is higher, especially when positioning is crowded. Liquidity remains the central variable. If central banks keep easing and fiscal policy stays expansionary, that liquidity can cushion volatility. If it tightens unexpectedly, whether from an inflation surprise or a policy shift, elevated valuations could adjust more quickly than people expect. One plausible path for 2026 is gradual repricing. In this scenario, economic growth slows more than expected. Corporate margins narrow because of higher input costs or slower revenue growth. Optimism around AI moderates as implementation challenges emerge, whereas productivity gains take longer to reach the bottom line. Political transitions introduce some regulatory friction, trade tensions rise in certain regions, fiscal debates create uncertainty around spending priorities. Under those conditions, valuation multiples compress. It does not take a crisis, it just takes expectations resetting toward more moderate growth. Leadership concentration unwinds gradually as investors rotate into other sectors or reduce exposure to previously dominant names. Credit conditions tighten modestly. Refinancing costs weigh more heavily on certain balance sheets. Risk premiums rise, but financial institutions remain stable. This is normalization, not collapse. Prices adjust to reflect slower but still positive growth. A different path involves sustained expansion backed by productivity gains and policy alignment. In this scenario, inflation continues trending towards central bank targets without re-accelerating. Rate cuts proceed gradually, keeping the discount rate environment supportive. Fiscal spending stays consistent, supporting demand. AI investments begin translating into measurable efficiency gains. Companies reduce operating costs while maintaining revenue growth. Earnings come in ahead of expectations. Political transitions produce continuity rather than disruption. Regulatory frameworks remain predictable. Global trade adjusts but does not fragment in a meaningful way. Elevated valuations prove sustainable because profitability justifies the pricing. Markets grind higher. Concentration persists because leading companies continue to outperform. Liquidity stays ample. Credit spreads remain contained. Volatility stays moderate. This scenario does not require extraordinary optimism. It requires steady execution across both corporate and policy domains. A third outcome is less dramatic, but worth taking seriously. In this case, the supportive and restrictive forces roughly cancel each other out. Growth slows modestly, but avoids contraction. Earnings meet expectations without exceeding them. Rate cuts happen, but inflation sits slightly above target, which limits how far policy can go. AI productivity gains show up unevenly. Some companies benefit significantly while others absorb transition costs. Political shifts generate periodic uncertainty but no structural breaks. Markets fluctuate within a broad range. Leadership rotates between sectors. Rallies fade as valuations hit resistance. Pullbacks stabilize as liquidity prevents deeper declines. Sideways markets test discipline more than risk tolerance. They reward patience and punish anyone waiting for a decisive trend that never arrives. Debt dynamics run through all three scenarios and deserve a closer look. When governments issue debt at higher rates, servicing costs rise and future fiscal flexibility shrinks. Corporations with floating rate exposure feel margin pressure as borrowing costs climb. Companies that locked in low fixed rates stay insulated until those maturities approach. Households face similar sensitivity to mortgage rates, consumer credit, and small business financing. The impact is gradual in most cases. It shows up as incremental margin pressure and slower growth, rather than sudden distress. But it reinforces why balance sheet strength and cash flow stability matter in portfolio construction. Technology adds nuance here as well. AI-driven productivity gains can offset some of these cost pressures if companies adopt tools effectively and reallocate labor toward higher value work. But the transition takes time, and near-term profitability may be pressured where adoption costs run ahead of efficiency gains. Climate variability layers in additional cost adjustments across agriculture, insurance, infrastructure, and energy. These are not the kind of headlines that define a year, but they influence margins and pricing in ways that compound over time. Market behavior increasingly reflects the speed at which information travels. Automated systems parse data releases and headlines instantly. Social media accelerates how narratives form. Price discovery happens in compressed timeframes. When the information is accurate, that speed makes markets more efficient. When signals are ambiguous or misleading, temporary mispricing can follow. The discipline that matters here is distinguishing between noise and signal. Rapid price moves do not always reflect fundamental change. Maintaining analytical focus becomes more important as the pace of reaction increases. Given everything we have covered, portfolio construction deserves clear attention. Liquidity gives you options. Holding cash or near cash assets means you are not forced to sell during a volatile stretch. Diversification needs to be real, not just owning a single index that is dominated by a handful of names. Genuine exposure across sectors and geographies provides better risk distribution. Time horizon alignment matters. Capital you need within a few years should not depend entirely on long-duration growth assumptions. Longer horizon capital can absorb interim volatility more effectively. Balance sheet strength and cash flow stability deserve extra weight when valuations are elevated. Companies with durable earnings tend to hold up better across environments. Professional adaptability is part of the equation too. As technology reshapes how work gets done, building new skills and integrating new tools strengthens your income stability. Career resilience and portfolio resilience go hand in hand. It is entirely possible that elements of all three scenarios play out over the course of the year. Markets could pull back as growth expectations reset, stabilize as policy support steps in, and resume climbing if productivity gains start materializing. Or they could oscillate between optimism and caution without committing to a clear direction. The point is not to predict which path wins. It is to prepare for variability so that you are not forced into reactive decisions. Risk management does not require timing the market. It requires defining what level of downside you can accept and sizing your positions accordingly. Overconcentration in any single theme amplifies your exposure to any shift in expectations. Periodic reassessment keeps your allocations aligned with your goals rather than with recent performance. Markets have always moved through cycles of optimism and caution. Structural shifts, new technologies, policy changes, and economic adjustments are constant features, not anomalies. Periods of elevated uncertainty often overlap with transitions, and investors who maintain discipline through those stretches tend to come out ahead. Entering 2026, valuations are elevated, leadership is concentrated, and several structural forces are converging at the same time. That widens the range of possible outcomes. It does not tell us which one will win. The appropriate response is flexibility. Emphasize liquidity, genuine diversification, balance sheet quality, and alignment between your strategy and your actual time horizon. Stay focused on durability rather than trying to predict exactly what comes next. Markets will keep adjusting as new information arrives. Narratives will shift. Volatility will show up in different forms. Investors who build for durability rather than precision are better positioned to navigate whatever 2026 brings. That is the practical foundation. Maintain discipline, pay attention to what is changing, and keep your strategy anchored to long-term objectives rather than short-term noise. That is how you navigate the convergence of forces shaping the year ahead.